Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Business mishaps, legal complications, loan defaults, property attachment. Now, these words and phrases have become part of common talk and commentary in the business world over the last few months as the economy deals with the fallout of slow growth. The current circumstances perhaps require a fresh look at how entrepreneurs, corporate promoters, and high net worth professionals are looking at managing their personal wealth. Planners have now started talking about the concept of wealth safety nets. So is there a clean, legally acceptable way of ring-fencing your family from the fallout of unforeseen business circumstances? Do these safety nets actually work? Well, Feroze Azeez of Anand Rathi Private Wealth Management is joining me on the show this week to talk about exactly that. Feroze, welcome to the show and thanks for coming in. Lots of news flow of late about what is happening, about business decisions that are going wrong and the fallout that they bring along with them. So I first want to start by understanding this idea of a wealth safety net. What are we talking about?
See, of course, when it comes to personal wealth, there are personal dependents who are attached to your personal wealth. So it's very important that any activity which you're doing, which is actually bringing risk to the family and its well-being and its next generation, needs to be thought of, and the risk should be kept away from all these activities. Of course, there are several methods to do that, to make sure that it is fenced. All the risk is in one place and all the dependents and their needs are in another.
So what are the avenues that we're talking about here? And before we even talk about avenues, I just want to, get clarification that we're talking about a very sound, legally acceptable way of ensuring how and where you park your wealth, right? This has nothing to do with sort of trying to get away from your responsibilities as a company head or a promoter and then trying to stash away your money somewhere.
No, definitely not. See, very importantly, are there legal methods? Of course, there are legal methods, and the ones which are as prominent. One of those methods is a PPF, right? Public Provident Fund is something which cannot be attached. Okay, so there might be 5 crore people who are using this safety net subconsciously, and the government itself is wanting you to provide for safety nets for your families.
So whatever wealth is or whatever money has been deposited in the Public Provident Fund cannot be attached under any circumstances?
Absolutely. So it's an automatic ring fence or a safety net which most of us or professionals or in the form of EPF, so many other people are actually subject to, and there is a ring fenced asset automatically. But there are of course demerits to it, that a PPF will not be you will not be able to access that money as smoothly. So it is ring fenced, but its availability is compromised. Its returns are compromised because you can't invest in equity when you use that safety net. That's where there's a need, and the quantums which one has in PPF might not be able to take care of the lifestyle and the expenses which you lead today. That's exactly why you need the second and the third method, which we might just discuss during the course.
Which are these number 2 and number 3 methods then?
See, one relatively popular now, has been popular for some time, is buying an insurance policy under a Married Women's Properties Act. Okay, MWPA is what they abbreviate it to. Automatically has this feature just like a PPF does. But the demerit of that is that if you buy an insurance policy...
And what kind of an insurance policy are we talking about? What sort of insurance under this act?
You can actually buy most of the insurance policies, but you buy it under this act or buy it as an individual. Those are 2 methods which one can choose. For example, I can buy an insurance policy in my wife's name and make her the beneficiary, and it's actually insuring me, but under the Married Women's Property Act. I can choose most insurance schemes under that act. So it's another option you tick. Like you have several options when you invest in mutual funds. Do you want to invest in growth option, dividend options? Similarly, in an insurance, that option is available.
So you can buy things like, I mean, are you talking about life insurance? Are you talking about property insurance? I'm just trying to understand the nature of these policies that can be purchased under the Married Women's Property Act.
It's predominantly life insurance. I was not categorically specific. It is life insurance, ULIPs. These are some of these schemes which can be bought under MWPA. They abbreviate it as MWPA. So
the schemes will stand even in the event of certain personal liability falling upon the individual who's bought these policies or bought these schemes.
Absolutely.
So that becomes the second way. Now, what about the third way to bring in or to create a safety net?
See, to mitigate the disadvantage of the second method is why the third method was actually introduced. The second method ensures that you buy an insurance policy. It might not be lucrative for you to buy an insurance policy. You would want to do whatever you wish to do with your money. That's why you create an irrevocable, indiscriminate private trust. This becomes the third method. You create, under the 1964 Act of creating trust, if you create a trust which is irrevocable and the share is not determined, indeterminate, the share of the beneficiary is not determined, then the safety net feature actually gets accomplished.
So can you elaborate on that when you say the share of the beneficiary is not determined?
Yes. See, what happens is, if I have actually created a trust, my son and my wife are a beneficiary, but the beneficiary interest in the interim during the life of the trust is not determined. Is my wife 50% and my son 50% or 70-30? That is not clearly defined. Okay. Right? It is only at the end of the trust, which is a 25-year trust which I've created, of which 3 are over. 22 years later, the split is determined only at the end, not in the interim phase. Okay. So even if there's a liability on my wife, this trust cannot be attached because her share is not determined.
Okay, fair enough. So how is the trust created? Who creates it? Who manages the trust? Who are the trustees? And the other sort of rules and regulations that go with this?
Correct. See, there's a large checklist to take care of. Who creates the trusts? Generally, a lawyer is the person who helps you create this trust. Of late, like a wealth management firm like Anand Rathi, for its clients, creates this trust. Because if a lawyer ends up charging 3, 4, 5 lakhs to create this trust, that's an exorbitant cost which people might not be very happy paying for an activity like this. So,
and where do you get it registered? I mean, how does it get legal sanctity?
It gets registered in the sub-registrar's office. Just like you go to register a property, you get your trust registered, trust deed registered, so that there is legal stamp on it.
Mm-hmm. And managing the trust and whatever assets and wealth goes into it?
Correct. There are two things. One is managing the trust itself and the other is managing the assets inside the trust. See, since it's not a very large trust with a lot of other activities but just personal wealths being managed, you don't need a professional trusteeship company. You need individual trustees. Generally, what happens is, if I've created a trust for Mr. X and he is actually creating a ring fence, he himself becomes the managing trustee and his wife becomes the second trustee, or somebody else who is his confidant becomes the second or the third trustee. But it's very important to make sure that the person who's creating the trust is not listed as a beneficiary.
Okay, so the creator of the trust cannot be the beneficiary. We've only just started. I have lots of other questions about the concept of this private trust. We'll take a break and continue our conversation. Welcome back. Here with Money, Money, Money. And this week we are talking about the concept of creating safety nets, the concept of a private trust where promoters or high net worth individuals can park their money using legally acceptable channels. So, Feroze, we spoke about how the trust is created, who the trustees and the beneficiaries would be. I just now want to understand managing wealth and assets within this trust. Is there any cap on whether you're doing equity or whether you're doing structured products or whether you're doing debt, or is it a complete freedom?
Yeah, absolutely. It's complete open canvas for you. Unlike the other two methods like the PPF and the Married Women's Property Act insurance policy, this gives you a larger landscape to do whatever you wish to, depending on whether you have goals which are near term, farther away, or equity needs to be 80%. You can do whatever with that money. You can buy property with it, you can buy bonds with it, you can buy mutual funds with it, you can buy insurance policies. The wide host of things which you can do with monies in your own personal name can be actually extrapolated to this trust.
Okay, so no caveats on what you can and can't do with the money that you're putting in the trust. But now I want to come to the red flags and the caveats that might go with this. It sounds like a wonderful concept for someone who's legitimately looking at ring fencing their family. But given the current circumstances, let us say that there is actually a loan default and there is a personal guarantee that a promoter has given, and that guarantee gets invoked because of the business circumstances. Then what happens to this trust?
See, if this trust has been created much before any of this activity was actually indulged into, then the person is actually safeguarding this trust through and through. So any personal liabilities one has, which is out of different activities, business activities, will not actually spill over to this trust.
Even if this individual might have given a personal guarantee on certain loans and agreements?
Absolutely, absolutely.
Okay.
Even if I have given a personal guarantee, then this trust can't be attached because of the key word which is there in the trust, which is called irrevocable. So it is no more my wealth. So if it's my personal guarantee, not my family's personal guarantee. So when I have given away the ownership of this wealth, so any liability on me cannot actually spill over to this. And I have given away ownership irrevocably, so I can never reverse this decision.
Are there any circumstances under which the concept of the safety net stops working, in which case it becomes null and void?
Correct. If there is a malified intent or a nexus proved between your activity and the trust creation, that you created this trust to be able to avoid this, and if there's a nexus created, then of course this whole safety net is lifted, and then the liability can move to the vehicle.
But that seems to be a bit of a, an open loose window, isn't it? Because proving whether intention was malified or not, or under what circumstances, when was the trust created, or is there, let's say, a certain time frame that you're advising clients that there should be a certain time frame within which the trust should be created, and a separation of, let's say, business issues and creating the safety net?
Actually, very, very good question, Surabhi. There is about a 2-year kind of a time frame, which is generally the recommended time frame to have created the trust 2 years before the liability actually came. Then it is generally considered as a bona fide intent of having created it.
All right, that's really important to keep in mind, that the trust should have been created at least 2 years prior to any legal issue or complication that might arise. Now, I just want to go back to the point that you made, that if I am transferring my wealth and assets into this trust, I'm anyway losing ownership of them. In which case, why create a trust? Why not just give away the assets to my family members or my children, etc.?
See, giving away ownership, like you rightly said, if I open up a trust and give away my money into the trust, I've given away ownership. But and the same thing can be done, I give my money to my wife, I have given away ownership. But that ownership can be revoked. Okay, I can definitely, I can transfer money to my wife, so can my wife transfer the money back to me.
Oh, okay. So that's not really ring fencing then.
Yeah.
The courts or, the banks, etc., and the legal process can ask for that sum to be brought forward.
Brought back to my account and then paid. But in case of a trust, what ends up happening is you have irrevocably taken that decision. So under any circumstance, you can't revoke this decision of having paid it. So you've given ownership for good. Here you've given ownership which you can revoke. That's the difference.
So Feroze, now coming to the all-important aspect of taxation, not that it's always the most important thing for an HNI, but nevertheless, just to understand, which of the 3 routes that you described to create a safety net, which is the most tax efficient?
See, of course, the PPF is one of the most tax efficient
Absolutely.
methods.
There's no tax liability there, yeah.
Correct. And so is the insurance MWPA, a very good tax efficient method. But the disadvantages are enough on the first 2 from a return perspective and suitability in case of insurance, that the third method is taxed as how much the tax liability would be as much as AOP, Associate of Persons, under the 1964 Income Tax Act. So you would generally not get, in a nutshell, all these exemptions which you get as an individual, the 1.5 lakh ATC kind of limit. But taxation has 2 parts to it. One is the taxation when the money is inside the trust, and the other portion of taxation is when the money is being distributed to the beneficiaries at whatever point in time. Could be an income distribution or the capital distribution at the end of the trust.
So wait, let me take the first part first, which is when the money is actually inside the trust and there is obviously wealth deployment. Now, whether one's buying equity or mutual funds or debt funds with that. So then how does the taxation take place on these different wealth instruments?
Correct. See, there are 3 heads of tax, right? One is income tax, business income, capital gain, generally the more popular ones. So capital gain, it will be identical to how I would invest in my name, or I would invest the money invested in the trust or in my name. The capital gain taxation is going to be identical.
Okay.
So business income and income tax, there wouldn't be any slabs. Okay, it will start with the same 33% from the first rupee. Right, so these are the two more important taxes.
So the trust will also have to pay an income tax on the income that the trust is generating.
If the instruments bought are producing interest income, for example, if you've bought bonds or debentures which are taxable, then you have to pay tax on that.
Okay, fair enough. So now coming to the latter aspect of it, when the trust actually distributes income towards the end of its life cycle, then what happens in terms of taxation?
See, the distribution to the beneficiary is absolutely tax-free, provided the conditionality being that the beneficiary is a close relative of the settlor. I can't make one of my friends who's not related to me a beneficiary and provide this tax benefit during distribution. So a trust beneficiary, if the beneficiary is a close relative, as defined by income tax, a relatives definition, where there's a wide host of people covered in relatives, then the beneficiary gets the money tax-free.
Okay, just a curious question. Can you add beneficiaries even after creating the trust? I mean, is there a scope to do that over the, let's say, the 20-year lifespan of this trust?
Yes, you can add beneficiaries, provided you've retained powers with you. So in the trust deed, if you've actually given the powers to the managing trustee to add beneficiaries, then you can. Ideally not advisable, unless you've put a clause that future children could be a beneficiary. Okay, so if I have one child today, in my trust it would mention that future children will automatically become beneficiaries. Then you're actually not mending any clause, you're just adding a family member into the trust as he enters your family.
All right, so very interesting concept, something that perhaps high net worth individuals can look at in terms of ring fencing their family, but with no malified intention. That is the most important point. We will take a break on that note. On the other side, we'll have some of your queries answered. Welcome back. Here with Money, and Feroze. Azeez of Anand Rathi Private Wealth has been talking to us about creating safety nets and how a private trust could be a very interesting route to ensuring that your family is ring-fenced in case you are facing